3, 2, 1. Welcome to the show.
All right. Welcome to the show.
I'm still wandering around the West Coast. Jerry's out on the East Coast. So we are virtual.
Excellent.
Like most of the world is right now, I guess, still.
Most of the world, you know, we're finally catching up to what everybody learned how to do from COVID, I guess.
Yeah, I'm out at this place that does a lot of software that we use for different things. And it's amazing. During COVID, during the pandemic and everything, whatever you want to call it, they completely redid their what do you call it? Their campus, right? And it's a small campus. It's not like Facebook or anything, but it's got that same kind of cool, software company vibe. And they did all this work to make it beautiful, and like half the people came back. And they're all like, yeah, I'm not coming back. So you got this beautiful facility, and I was like, man, this is a struggle for everybody. Like, they did the right thing. They invested in the place. They made it better. I mean, it's cool. It's crazy. It's beautiful. I wish I should have taken some pictures to show on the show. But anyway, I thought it was interesting because so many companies are dealing with this. And I know, most I guess we're dealing with it in the federal government. Not as we don't see it as much because we're retired. But I know I hear about it sometimes that are like people that, like in our former life, right? If you were an 1811 investigator, the chances that you were ever going to really work remotely is like never happening.
Zero.
And it's happening now.
Never happened.
And it's happening now, and we know people that are in the Intel world, and that was like never, ever, ever, and they're doing it. It's amazing. So I know I sidetracked us, but what you got?
Times changed.
Week?
That's all right.
Yeah.
Dude, well, I tell you what, I know you're inundated there with software stuff, but you missed a heck of a day on the market.
I know. I haven't been able to look at anything.
Yeah. So it's Thursday night. We're not quite done with the week, but it has been a crazy week. Particularly today. So I get up at 6 o'clock this morning, East Coast time, like I always do, because that's when the futures open. And we were up about 1.5%, I would say. And then 8:30, a whole bunch of really important numbers came out. The biggest one was the CPI. PPI came out a couple of days ago. CPI came out today, and it was higher than what was expected. And so we went from about 1.5% up in the futures to by about 10 o'clock, 10:30, we were down 2.5%, almost 2.5% on the S&P 500. Mm. And then I don't know what time it was. I think I went to walk the dog and I came back and the market had exploded higher, and kept on going. We didn't finish quite at the top of the day's trading range, but we closed up like, I don't know, a little over 2.5%. So there was like a 5% swing for the day. It was an unbelievable day. And I got a couple questions on Facebook, tonight about it. What did I think caused it and all that? I have no idea what caused it. And I don't have any charts to put in about this thing, but here's the thing that I think is really interesting. And we'll see how this plays out tomorrow, but we've been talking a lot about the dollar. When the dollar goes up, the market goes down. When interest rates go up, the market goes down. The dollar was up today, a little bit, not a lot, but it was up a little bit. Interest rates were up. In the beginning of the day, they were up a lot, both of them. But by the end of the day, they had come back down, but they were still both positive for the day. So theoretically, the market should have been a little bit negative for the day, but the market was way higher, right? So those two things don't align very well. But the biggest thing that doesn't align is the VIX. So I put out a chart earlier this week or last week, I can't remember, and it basically showed in 2008 the same setup that we have right now on the VIX. And so I was saying that if it would just take some kind of breakage in the market, like what everybody is expecting, that the Fed interest rates are going to ultimately break the market, and the market's going to tank, and then the VIX would spike. So I'm looking at today, and like I said, the market gapped down huge. We were down almost 2.5% this morning, and the VIX didn't even move. I mean, it didn't. I went all the way down to a 1-minute chart, and it didn't move. It didn't get above 34, which is remarkable to me. And then when the market flipped back around the other way, the VIX did come down a little bit, which when the market goes up, the VIX comes down. But the VIX didn't come down anywhere near to the level that it should have, given the huge reversal rally we had. So I don't know what's going on. There's some shenanigans going on in the market. That's all I know.
Shenanigans.
Yeah. I don't know what it is, but it's not right. And if you're trying to play this even as a day trader, I mean, people got absolutely smoked today.
Yeah. Yeah, I'm glad in a lot of ways that we can't do that kind of stuff, because it would just be frustrating to try, and we know that that's not, it's difficult to do even on a weekly and monthly basis, more like what we do, but on a daily basis, oh my gosh, like these huge swings possible. And not worth it.
Yeah. And so
it's possible.
What we're going to talk about today, it's crazy. What we're going to talk about today is extremely timely. Okay. I just kind of turned out that way. And so let's just get to it. So Weekly Update Show, 16 October 2022. So I'm going to flip it around this week a little bit, because ordinarily we do the TSP fund charts at the end. And I'm thinking maybe some people don't watch the show all the way to the end. So I'm going to do the TSP fund charts. I'm going to do the TSP fund charts first. Okay. But it's also because it's going to feed into the longer term charts and some observations we're going to make about that, which ultimately feeds into the question of the day: is it too late to go to reallocate to the G fund? Okay. And so we're gonna talk a lot about that all the way through this whole thing. So that's the thing to keep in the back of your mind. Is it too late at this point in the game to reallocate to the G fund? Okay, TSP fund charts. So this is a 3-year weekly chart of the C fund. Okay, we do it usually at the end of the show every week. And again, this is as of the close on Thursday. Okay, so here we are right here. That's 4 days of the last 4 days of price movement. Okay, it's the week we're in right now. So for our purposes, what we always say is, if you are above this 20-week moving average line, that's the blue line. If you're above the 20-week moving average line, the market tends to correct down to that line and then keep moving higher until it doesn't. Okay. So we had from the COVID, well, say when we got back above that line after COVID, so end of April 2020, we were in a consistent uptrend until that first week of January of this year. Okay. Ever since then, the market puts in, we had a high in January. We had a lower high at that March rally. We had a lower high at the August rally, and we have consistent lower lows. Okay. Even to today. Right. So we need price to be above that 20-day moving average line. Sorry, 20-week moving average line, if we're ever going to get a new rally to happen. Obviously, there are throwovers, right? So every time we get above that line doesn't mean that a new rally, is taking hold. There's a lot of technical analysis in there. We got a little bit of this move. We got a little bit of this move, but we've been in the G fund almost this entire time. So if you're just looking at the market on a weekly basis, this is kind of the best chart you can follow. If you want to be on the right side of the trend, you want to be in the market when the weekly close is above that 20-week moving average line, and you want to be out of the stock funds when the weekly close is below that 20-week moving average line. Okay. So all the stuff that happened today, a 5% move, 2.5% one way, 2.5% the other way, and for the week, that's where we are. So we really haven't moved much for the week. Okay. We also have relative strength way down here below the 50 line. So we want to see price above the 20-week moving average line, and which is kind of consistent back here. Once we got above 50 on the RSI, we stayed there until January, right? So if we're above 50 RSI, the market's going up. If we're below 50 RSI, the market's in a downtrend, right? This is pretty much the only chart you need if you're looking at the market on a weekly basis. But you're not going to catch the bottoms, right? And you're not going to catch the tops. It's going to keep you on the right side of the long-term trend. Okay. Last thing about this, here's the top right before the crash in COVID. It's right at 3,400. Is that close? Is this wick from today's low, is that close enough to 3,400 so that the market starts moving higher? It's possible. We'll have to wait and see. Okay. S fund, same kind of thing. Once we got back above the 20-week moving average line from COVID, everything was good until, in the case of the S fund, it was actually the end of 2021, November 2021, we broke down, and every time we tried to rally back up to it, hit resistance, had a little overshoot here on the most recent rally, but consistent lower highs and consistent lower lows all the way along. So we don't want to be in the S fund. And same exact thing with the RSI. Once we got above 50, we're good. Once we get below 50, not good. Okay. And we're already below 1600 was the COVID top. So we're looking for support at that COVID top. And there's also a lot of churning at that 1600 level here, right? Up, down, and eventually it rallied from there. But there's a lot of activity going on here. So we would expect, the same kind of thing to happen here. We're looking for support at that level, and we're not seeing it. So again, based on these charts, not the time to be in the stock funds. I fund is a complete disaster. Here was the top from COVID. We're way past that. We did have a big move higher today, and the last 3 weeks of closings were pretty much, right at that 57 level. We're way down. RSI is way down here. So the I fund has a lot of work to do, and just the shape of it in general is like this waterfall, and it's consistent with the macroeconomics, right? Because Europe is in a much, much worse place than we are in the US. Okay. And the bond fund is worst of all. We've talked about it. It's I think since the late 1700s, this is the worst sell-off in the bond market since like the late 1700s. There's a lot of people watching the bond market. We're actually going to talk about it very specifically in the newsletter this weekend. The theory is that, I don't have it to show in the charts, but if you're a subscriber, definitely you want to look at the newsletter this weekend, because we do a bunch of charts about this. If you look at the AGG is the ticker symbol for the aggregate bond index, which is what our F fund tracks. The TLT ticker symbol is the 20-year U.S. Treasury bond chart. That actually, if you look at the TLT, when the stock market goes down hard, the TLT goes up really, really strongly. So, and the inverse. But since 2022, both the stocks and the bonds have both gone down in tandem. At some point, the idea is that if we get a full-out collapse in the stock funds, there's nowhere else to go but bonds, and so bonds take off. So there are a lot of people watching the bond market right now, on the edge of their seat, waiting to jump into bonds. Bonds will rally first, ultimately, before the stock funds do. And we're going to get into that quite a bit in the newsletters over the next, as this starts to play out, because it looks like it's happening here kind of imminently. Okay, so now we're going to take a look at some long-term charts and some observations. All right, and again, the whole point of this is to lead us to that question of does it make sense to reallocate to the G fund? So here's a chart. It's a weekly chart, okay, of the C fund. It goes all the way back to 1980. Okay. This is the 200-week moving average. So the last charts that we were looking at were the 20-week moving average, right? Much closer time frame. It was a 3-year chart of the 20-week moving average. This chart goes back 42 years, and we're looking at the 200-week moving average. The chart is logarithmic scale. Okay, it's not price. Here's the price, and you can see how it's all kind of compressed together at the top. The reason is from 250 to 500 is 100% move in your money, right? So if you look at the distance from 250 to 500, it's the same distance as 500 to 1,000, right? Which makes sense because it's 100% move from 250 to 500. It's 100% move from 500 to 1,000. It's 100% move from 1,000 to 2,000. Okay. So this helps us see long-term, whenever the price fluctuates a lot, or you're looking at a long-term chart, it's much better to look at it in a logarithmic scale, right? So we look at this logarithmic scaled chart of the 40 plus year weekly C fund. Okay. Every time we get a correction, we get support at that 200 week moving average, except for 3 times. Okay. It was right here in 2000 during that market crash, right here in 2008 during that market crash, and COVID, which I'm going to call it like a one-off because it's a worldwide pandemic. It's not a traditional kind of bear market. So I'm gonna kind of pretend that didn't exist, right, for the sake of the argument. So every time in the past 40 years, and it doesn't happen very often, but every time in the past 40 years, except twice, the market found support at that 200-week moving average. Okay. And where are we right now? We are right on it. Right? We are right on that line. So if you roll the odds and say, well, most of the time it bounces higher, so I'm gonna jump. If I'm in the G fund, I'm gonna jump into the stock funds now because it's at a low, it's at a support level, and it should go higher from here. Because every other time except twice, it went higher from here. That's absolutely something that a strategy that you could do. Because then you would say, well, you could say, well, if it gets below the line, I'll just get out, right? At some point, it's below the line, and I just get back out.
Yeah, well, I mean, what if you're already out, like we are, right? So you're saying if you're looking when to get, I mean, the way I would look at that chart is, this is the time that we want to be watching it like a hawk.
Yes.
Because 1000%. If it crosses that line, it's going to be bad. If it bounces back off that line and starts a longer trend up, well then, good for it.
It's all good.
Right.
Right. So to the question of the day, right? Does it still make sense? How do we put it? Is it too late? That's what I was getting. Is it too late to go to the G fund? Well, if we're looking at this chart, you're down about 25% right now. If you're 100% C fund, you're down about 25%. So if I'm right on that support line and I've already absorbed that 25% loss, and I know that most of the time in the past 40 years that it hit that line, it rallied higher off that line. So no, right? So is it too late to go to the G fund? Yes, it's too late. I'm looking at that and I'm going, okay, if I'm already into it for 25%, if it breaks below that line, then I know bad things happen. So I'm getting out. That's when, this is the final line in the sand is what I'm saying. If you've ridden this thing down to this point, you've ridden it down to this support level, that's fine. If it breaks that support level, then there's no reasonable point looking at this chart to continue to be in the stock funds. Okay. The other thing, we're going to get to it in the next chart.
I hope that some buy and holders are watching this part right there, and if they've held out this long, and they've said to themselves, okay, it always goes up, blah blah blah, right? You just lost 25%. I feel bad for you, but you wrote it down. Okay, if it crosses that line though, there can't be any bigger sign that says you have to get out. because you don't know, no idea how far it could go from there.
Right. No way of knowing. Right. So that leads us up to the next chart. So all I did was zoom in the last chart. Instead of going back to 1980, we're back to 1999. Okay. So at the top in 2000, that's about 1600, right? Here's 1500. It's about 1600 on the S&P 500. If you came down to 1250, which is where we had a cross of that 200-week moving average line. If you had ridden this down from the top in 2000, right? We broke below it, came back and tested it, and then rolled over. So anywhere in there, in that 1250 level, you are 25, more or less 25%. I ran the numbers before and I don't have them in front of me now, but you were more or less 25% down, right? From 1250, we came actually, let's do it on the 2008 one instead, because we hit 1600 up here. We were also down here at 1250. So you were like 25% down from here. So if you had $1 million up here in 2008, you had about 750,000 when you were deciding whether or not you wanted to stay in the C fund, let's say. Say you had $1 million, came down to 1250. Now you get 750,000 left. From 1250 to the low, which was 666, right? 625 times 2 is 1250. So you basically lost half of your money. You lost 25% from here to here. Then you lost another 50% from there to there. Right? So your $1 million up here is about 300,000 down here. 400,000. About 400,000 down here. I don't know how long it took most people to make their first million, but to watch it come down to 400,000 is pretty agonizing, to say the least. So if you're buying and holding, that's an example of what would have happened back in 2008. Doesn't mean it's going to happen going forward, but
yeah. But how easy is it? We talk about this all the time. How easy would it be to just watch that line? And if it crosses that line, it's like there's just no other way you have to go. The trend is, if it's broken that trend, you've got to be out. And sure, you would have taken a pretty significant loss already, but you wouldn't be taking the larger loss. And it's right. Crazy to me that it is that simple, and we preach it all the time, and people still argue that it's not, like it's worth it just to ride that all the way down and back up again. And it just boggles my mind.
You can ride it, right? So you have $1 million here at the, last quarter of 2007, and you say, nah, I'm just going to ride it out. The next time you get up to that level is the middle of 2013.
Yeah. I mean, you can ride it out. I agree. I just don't know why you would.
Ride it out.
Right.
I have no idea.
I don't know why.
And really,
would.
the
when all
crazy
you have to
thing
do
is
is
if
get
you
out
come
at that
back here,
line and get back in at that line, and your world is remarkably different.
Yeah. I mean, that's a good point. So
you don't even have to catch the bottom.
I mean, I wouldn't
get out at that line.
Right.
Get back in at that line.
Yeah, you could do that. It could be that simple. I mean, for me, it's the easiest way to do it is just connect these tops, and once it breaks those tops, I mean, you're getting in right there, right? And it's the same thing here. Once this bottom was in and we got back above that high, like that, there's absolutely no reason to be out of the market at that point. So you don't have to wait, to get back up to the trend line. You're not going to get in at the bottom by the way we do it, but
but even
you're going to save.
Even the worst case scenario of that chart is just to wait till it crosses the line again. You're still far better off than someone that rode it all the way down and up, because your account balance just stayed the same.
Right. So again, one of the things that people always say is, well, I'm buying shares cheaper as the market goes down. And that's absolutely true, right? if somebody wanted to say that, you want to be buying more, contributing more to your TSP as the market goes down, and contributing more into the CNS because you're buying shares cheaper as the market goes down, I do not disagree with that. The problem that I have with it is if you have $1 million up here in your account balance, right? Let's say you're getting ready to retire or you're already retired. If you have a lot of money in your account balance up here at the top, number one, you can only contribute while you're still an employee. And number two, the percentage that you are able to contribute, right? Right now it's $20,500 a year. The percentage that you're able to contribute is so small compared to what your account balance is.
Exactly.
Yeah, it's insane.
That's where people lose it right there. I mean, you just hit it on the head. Just because I can buy it, I'm not going to keep up with it's. It's like betting on a losing horse. Like it's you're. Does it work to buy shares cheaper? Sure. Not in this. Not in this scenario though. You can't buy enough shares.
Like right. Like if you so in my mind, I still have a hard time with the new TSP system, so I'm just going to kind of revert back to the old one. But if your core account was in the G fund, once the market rolled over, so let's say you move to 100% G fund right here, after taking that 20-something% loss. So now your $1 million is 800,000, and you're still an employee, so you keep contributing and you keep buying CNS or whatever all the way down and all the way back up. That's fine. I would argue that if I'm contributing, 1,000 a month between my contributions and the matching and whatever, if 1,000 a month is going into my account, I want it going into the G fund because I'm buying shares of the G fund that are increasing in value, right? Not by much, but they're increasing in value as the market is going down. And so that means my account balance is going up, right? Forget about the number of shares I own and what shares I own. My account balance is going up as I'm buying shares in the G fund while the stock funds are going down. Then when the stock funds stop going down and I get back in, now instead of having 500,000 in my account, I have $1.2 million in my account, and then I'm getting this huge move higher on $1.2 million. I mean, it's philosophical to a degree, but it's really not.
I would say it's not philosophical at all. I would say that's called math.
I'm doing the best I can. Yeah, it is
that's
called
math.
I'm doing the best I can to try to not make enemies on the show here, but it is my job.
I mean, that's my job. Jerry's a nice guy.
Okay. Sometimes.
Yeah.
All right. So that's the C fund. This one is even worse. Okay. This is the NASDAQ. So everybody's familiar with the NASDAQ. It's the tech, it's the tech index. All right. When the NASDAQ topped here in 2000, it was, 5,250. Let's call it 5,000. Makes the numbers easy. NASDAQ tops at 5,000 in 2000. We got a big drop, a recovery, a huge drop down to 2,500. So what just happened? What just happened at that level right there? You lost half your money. Okay. That hurts. No doubt about it. That hurts. And if we did a chart further back, we get a bunch of these, just like on the C fund, a bunch of times where it comes down and tests that 200-week moving average and moves higher. So you lost 50% of your money right there. And you say, there's no way I'm getting out now. Like that wouldn't even make sense. I know the market always goes up and there's just no way that it can't go up from here. Okay. From 2,500 to 1,250. How much is that? 50%. So if you had $1 million up here, you had 500,000 when we hit that 200-week moving average line. If you stayed in the NASDAQ, right? Obviously, we're not talking about the C fund, we're talking about the NASDAQ, but just to prove a point, if you rode that down to the low in, not even the low, I'm just making the math easy, to just before the low here in 2002, you went from 1 million here to 500,000 here to 250,000 here. I mean, and you went a little bit lower actually from that, right? I can't even imagine if you are close to retirement or in retirement and you have $1 million and you think the market's always going to go up, your $1 million, you have $1 million in 2000, and by the middle of 2002, your $1 million is now $250,000. I can't even imagine. And the NASDAQ actually made it easy for us on this recovery, because once we put in a low, we got another move higher, just like all these bear market rallies, right? And the market rolled over. But this time, what happened? It rolled over, but it made a higher low. Okay. That's how you know things are different. Once we got back above this high right there, that's your last line in the sand to get back in. Right? It's an absolute no-brainer. And then you get this move. Of course, then you get all this in 2008. But so all this to say, even if you're 50%, if you've lost half your money, can it still go much lower? Absolutely. It has. This is a historical example. I'm not making this up. So, okay, last thing, just because all we've looked at so far is the 200-week moving average line. Another really common, and this is just sort of educational purposes, another really common thing that people do is draw trend lines, right? So in this case, the price is not logarithmic. Okay, it's straight price. So if you want to see the long-term trend, all you do is connect the bottoms, right? They always form a line. You connect the bottoms, and then you expect the market to come down to that level and keep on moving if the trend is going to continue. Okay. So if you drew this chart back to 2009 with just the standard price, this is what you're looking at. And so you're thinking price needs to come down here to about 3,000 before hopefully we get support and we start moving higher. That's like a standard price. This is the logarithmic version of that. Okay. It's the same chart. It's just logarithmic. So the reason it's so different is because from the bottom in 2009, that first move off the bottom was so explosive on a percentage basis, right? It was so explosive that the correction didn't correct that much relative to the percentage move higher. So back here, it looked like this. It doesn't look like much, right? But you're going from 666, or yeah, it was 666 on the S&P up to 1250. That's a 100% move. So you can really see that on a logarithmic scale, okay, which is why we do that. So here's the first low on the logarithmic scale, and we just do the same thing, connect the lows, right? We had an overshoot from COVID. That's fine. We are right on that line again. Okay. So I'm not going to come out and answer the question. I think we already did that, but I just wanted to show you guys that. So is it too late for the G fund? We do active management, right? We're looking at the price and the technical indicators to help us make a decision about the expected continued direction of the trend. Okay. So if you actively manage your account, then it's never too late to move to the G fund. Because if you think the trend has changed, no problem. Move to the G fund. If you're wrong, you're going to identify it really quickly and you're just going to move back to the stock funds. It's no problem. It's not like you're locked in, right? The G fund is just a place to park your money until the trend starts moving to the upside. The G fund protects you from any additional downside risk by law, right? By law, you can't have a negative quarter in the G fund. So it protects you from all risk, and nothing else does that. protects you from all risk. You always get a positive return. You can have a negative return in the F fund, but you cannot have a negative return in the G fund. Even when rates were zero, we still had a positive return in the G fund, right? It's small, but it's better than taking any losses. And probably the most important thing is you go to the G fund and you can say, okay, let me reevaluate and see where I am, see what my circumstances are, and what do I want to do moving forward? Do I need the money? Am I going to retire? Do I need to pay off my house? Do I need to, am I looking to buy a second home or whatever? Am I going to do something with the money? If you're 25 years old, that may not apply, but if you're retired, it matters a lot. And you can always reallocate back into the stock funds. You're not locked into any of these. Okay. So that's what you're thinking about if you're if you're actively managing your TSP account, whether it's, whether you're looking at it daily or weekly. If you understand this active management concept, those are the things you're thinking about. If you're a buy and hold investor, then this question is pointless. You're going to ride this thing down no matter how low it goes. Because if you don't, since you don't actively manage it, you will lose. You will get out at the bottom and not get those gains on the backside. Right? That's the problem with buy and hold. It's a mentality, because you are sort of mentally, you're like, all right, I'm throwing in the towel one way or the other. And once you throw it in, that's it. You move on to something else in your life. If you're actively managing your account, you're watching it and you're making decisions based on what the market tells us to do. If you're throwing in the towel, then great. You're going to get whatever the market gives you. And so so if you're a buy and hold investor, then all of this makes no sense whatsoever. The last question is, we get it all the time on Facebook. Is it too late to go to the G fund? What are you actually asking when you ask that question? Right? I'll tell you what I hear. When I read that, what I'm hearing is, I want someone to tell me which way the market's going to go. Is it going to go lower from here, or is it going to go higher from here? As a final decision, right? So when you ask on Facebook, is it too late to move to the G fund? From my perspective, the answer is always no, it's not. Now, we've just spent the last, 30 minutes looking at how we're right on that support line right now. So would I move to the G fund right now? Absolutely not. Right? I would look at that line like a hawk and give it a little bit of breathing room. But if it goes very much below that line, yes, now it's time to move to the G fund, because we can see what potentially could happen. And if it does a little head fake, great, it gets back above that line. That's the long-term line. Now you're drilling down to the 3-year weekly chart where we're doing 20-week moving average lines. Once it gets back above that 20-week moving average line, no problem, get back in the stock funds. So I don't know if that was a bit of a rant. I get frustrated with myself for not being able to answer that question, because it's really a simple sounding question. Is it too late to go to the G fund? But it's much more complicated. What you're actually asking in that question is much more complicated than what it seems like. All right, I have to take a break. Bryce, breath.
I mean, it's a difficult question to ask, or to answer, right? And it's not hard to ask it. But you're right. People are really asking, well, what should I do? And you want a crystal ball. You want someone to say, well, this is what's going to happen, so this is what you should do. Right. And if you're, a subscriber to our site, we've already told you what to do, or what we're doing, rather. And so you can, follow that or not follow that, or validate it, or whatever you want to do. But we got out a long time ago because the trend changed, right? And so now, that question to us, of course, if you're following us, doesn't make any sense, because we're like, well, we're already out. So is it too late? No, but it's never too late. I agree with you. It's never too late. Let's say it passes that line and you're really freaking out and you're like, I don't know what to do. It's not too late, because you don't know how far it's going to go. And why not park your money in G, take your losses, right? And just wait it out. And then when the trend changes, jump back in. But if you're buying,
that's the thing. We did
Yeah, sorry. The buy and hold thing, you're right. Like, why are you even asked the question if you think it's, then why are you even looking at the market if you're truly buy and hold?
Right. That's right. Yeah. We did a video recently about, buy and hold. At the end of the day, you either okay, now I had lost my train of thought there, but now I'm back. Okay. So locking in losses. If you had $1 million in January 1st, 2022, and you've ridden this market down, let's say now you're 25%. So now you're $750,000. That's what your account is worth, right? So forget about buying shares cheap and all the rest of it. I'm just talking about your core account. You have $750,000 in there. The trend is down. You can either ride it down, or you can stop digging a hole. Okay, you can stop the down. You can stop losing money as the market continues down. The flip side of that is you have to be watching to get back in when the market tells you to get back in. So that's sort of why it's never too late to move to the G fund, because even if you're down 50% and you're like, I can't take it anymore, I'm out. That's fine. Get out, take a breath, but watch the market, because when it does bottom, and maybe it bottoms the next day, maybe you got out at the exact wrong time. The idea is to get back in at the exact right time. So in the same way that we got out on January 6th of this year, we're going to get back in at as close to the bottom as is reasonably possible. So
yeah, I mean, I think it's important for people to really grasp what you said a second ago about your performance metric, right? A lot of people want to use a lot of different performance metrics, and I think for TSP 401k IRA, what you should use is your account balance. It's the simplest way to look at it. What is the amount in your account? Is it going down? Is it staying relatively steady, or is it going up? Forget everything else. If it's going down, and the trend, if you're following any sort of chart at all, right? If the trend is going down, why not move it to the G fund so that it stays stable, and then wait till you feel confident enough with the information that you have, right? The trend has changed, and now you're back in. The account balance should be your metric.
Yeah, I agree. The thing that the problem that I have with this is that if you're down, I see it all the time on Facebook. You can't get out now because the market's down so far, you're locking in your losses. Well, that assumes that if you go to the G fund, you're going to stay there, forever? I mean,
right.
There are no losses.
That's the misconception, right? That's where it starts to lose its, no, I'm not locking in any losses. I'm keeping my account balance from going down any farther, right?
Yeah.
But I mean, I've already lost it.
Yeah, your balance is what it is.
I'm not locking anything in. It's already down.
It's already locked in.
Yeah, that's the part that I mean, it took me a long time to wrap my head around that. And I understand why people don't, because they listen to CNBC and Bloomberg and Yahoo Finance and all of these things, and these folks are not talking about your retirement account. They're just not. And so it's not the same thing. And at the end of the day, if your account balance is steady, staying the same, you're not losing money, you're good, right? You want it to rise, you want it to go up, obviously. But if the market is tanking, your account balance is going down. That doesn't make any sense, right? It just doesn't make any sense. You've already locked. There's no locking in anything. Your account balance is going down. That's your metric.
Yep, that's it. Yep. I think
getting off the
totally
soapbox.
Beat it up. And if you don't get it, and you want to talk about it some more, hit us up at support@growmytsp.com. But it's crazy because there are people vehemently on one side of the fence or the other, and that's just the way it is, I guess.
It is.
I mean, we're doing everything we can to try to educate people. But if you're not willing to entertain the possibility, then there's not a whole lot we can do.
Can I get an amen?
No, I might get lightning bolts or something. All right, brother, I'm done for the day.
You got to hit that slide.
Oh, is that what you're waiting for?
Boom.
Questions.
See, this is what sucks about you doing the charts in the beginning. Is my cue to know that the end is coming is when you get to the F fund.
Oh, that's right.
So until you hit the question slide, because I don't see the slides before everybody. I'm just like the viewer. I don't know what's coming. I like that surprise. Right. Yeah, it's funny. All right, if you have questions, be sure to send them to us at support@growmytsp.com. That'll get to the support team, and they will forward it to us if it's something we think we can answer. If it's really specific and your personal circumstances and your financial, we can't get into that stuff. We can't give financial advice over email. But if it's an education related topic, we'd be happy to answer it, talk about it, or do us. More than likely, we'll just do a thing on the show that kind of gets it out to everybody. Because if you have a question, more than likely there are other people who have that same question. Wherever you find this video, hit us up with a comment on Facebook, YouTube, wherever the heck you find it. We blast it out all over the place. Yeah. All right, guys. If you like the show, share it with your friends. If you don't, share it with your friends.
Share them too.
You got any other words of wisdom for us there, Jerry?
I think if today is any indication, the market just gets more volatile from here. There's a lot of angst. There's a lot of reasons why the market should explode higher from here, and there's a lot of reasons why it should explode down from here. Yeah.
And I think it's important to remember that the market is people, right? That's what it is. We think of it as the stock market as this entity of its own. It's people that are making this thing move, right? And a lot of institutions, obviously, but it's people.
Yeah. Well, the institutions are people too. I mean, at the end of the day, everybody is trying to hedge their way through what the macroeconomic picture is telling us is very, very bad. So, we don't talk. You can look at tons of people on YouTube that talk about macroeconomics, and I don't want to. I watch that like all day, every day, but I don't want to kind of bring too much of that into the show. I want it to be kind of strictly, technical analysis. But you need to be aware of what's going on in the world and see if that matches up with what's actually happening in the charts. It doesn't mean that, if everything is doom and gloom, then the stocks go down. That they don't correlate like that. Mm-hmm. But you have to know what's going on in the big scheme of things to know, for example, that when we had that rally in June, July, and August, everybody was all excited about that 50% rally, and it was valuable as a time that you should have gotten out if you were in the stock funds then. We talked about it back then. I think I was still up in Boston at the time, and I did this thing at the very end of it, which I never do. I'm like, guys, this is the last best chance to get out.
Right. Because
we had just come up to that 20-day moving average line, hit resistance, and rolled over at it. And I'm like, that's it. Like, and the market came back down, and we're at new lows again. Do we get another rally from here back up to that 20-week moving average line? Possibly. I mean, I don't know. But in the big scheme of things, the macro is so bad. The next rally probably isn't the one that's going to take us to new all-time highs. Those are the kinds of big picture things that you need to really think about.
100%. All right. On that note, guys, I hope you have a great week, and we will see you next week here on the show.
Out of here.
Peace out.